Welcome to this explainer. Look, I'm absolutely thrilled to have you here today because we're going to unpack a concept that frankly flips conventional business wisdom completely on its head. Are you treating your taxes like some static end-of-year checklist? If you are, you're making a fatal operational error. Today, we're going to uncover exactly why this mindset trips up so many executives, and more importantly, how we can fix it. Okay, here's our strategic briefing for today. We'll kick things off with the fatal tax mistake, move into the massive shift from compliance to architecture, and then dissect the three major flaws of traditional tax education. Finally, we'll wrap up by looking at how you can turn your tax architecture into a tangible asset. Let's get right into it. So, part one, the fatal tax mistake, the illusion of the static checklist. You know, most entrepreneurs look at taxation through a deeply flawed lens. They just see this rigid checklist of rules and deadlines. But in dynamic, developing economies, think places like Tajikistan or the broader Central Asian market, fiscal policies are constantly shifting. Just imagine building your entire profit margin around a specific tax loophole or maybe a temporary small business rate, only to have a new government regulation close it overnight. Building a business on the rote memorization of static rules doesn't just cause minor inefficiencies, it literally guarantees structural collapse. There is no way you can build a scalable, modern enterprise on a foundation that changes with the political wind. Moving on to part two, compliance versus architecture, the core paradigm shift. To survive and scale, executives really need to elevate their perspective here. Traditional tax compliance, it's entirely focused on historical reporting. It's totally reactive. Your accountant is basically acting like a historian, looking backward at the calendar and asking, okay, what happened last month and how do we report it so we avoid penalties today? In that scenario, tax is just a frustrating afterthought. Financial architecture, on the other hand, is all about forward-looking system design. Instead of acting like a historian, you're acting like an engineer. You're asking, how does our revenue model, our supply chain, and our corporate structure actually interact with the tax code? Taxes aren't just deducted at the end as some nasty surprise. They're engineered directly into your prime costs from day one. To truly grasp why this shift is absolutely crucial, let's systematically break down the three structural flaws of the old model. And keep in mind, these aren't just theoretical errors. They're actively destroying operating margins in businesses as we speak. We're talking about static memorization, the separation of taxation from unit economics, and the accountant's shield fallacy. Which brings us to part three, flaw one, static memorization, and the danger of temporary variables. So the first major flaw is teaching current tax rates as if they're immutable constants. But we all know that statutory thresholds, special regimes, and tax exemptions shift constantly. If you build your business model around a temporary tax loophole, you're essentially building a house of cards. The second regulators change their minds, boom, your operating margin is destroyed. The main takeaway here? A true architect designs a financial model that stays resilient even when those tax variables change. You build for flexibility, not for today's temporary discount. Part 4. Flaw 2, unit economics and the illusion of profitability. Traditional training totally divorces taxes from daily operational pricing. But think about the equation for true profit margin. It equals your revenue minus the sum of your direct operational costs and your embedded tax liabilities. Let's make that concrete for a second. If you calculate your gross margin without baking transactional taxes, like that, turnover tax, or local digital taxes, directly into your unit cost structure, you are systematically underpricing your products. You might look at your bank account, see cash flowing in, and think, hey, we're making a profit. But it's a total illusion because the tax bill is just hiding out of sight. And the really crucial point here is that ignoring these embedded taxes doesn't just reduce your profit on one single isolated sale. Think about what happens when you take that flawed unit economic model and try to scale it up. That error multiplies. Scaling up actually compounds your structural tax debt. If you lose a little bit of margin on one single widget because you forgot the tax, you're going to lose a massive amount when you sell 10,000 widgets. At that point, you aren't growing a profitable business, you're simply pouring gasoline on a fire, accelerating your cash burn at a faster and faster rate. Part 5. Flaw 3. The accountant's shield and the delegation trap. So who is designing your commercial workflows, right? It's a critical question. Entrepreneurs frequently delegate all their tax matters to operational bookkeepers, essentially using them as a shield against regulatory authorities. But standard bookkeepers are trained to record past transactions. They're not trained to engineer corporate strategy, optimize supply chains, or model B2C scaling goals. If they aren't designing your workflows with scale in mind, then who is? And this leads us straight into the accountant's shield fallacy. Look, it's not the bookkeeper's fault. They're doing exactly what they've been trained to do, which is minimize immediate risk. But when an operational bookkeeper who, let's be honest, lacks the full picture of your corporate strategy is forced to make structural tax decisions, they're going to default to the most conservative, bureaucratic, and growth-restricting methods available. Instead of protecting your business, this delegation trap ends up choking your operations, slowing down your supply chain, and completely stifling your growth potential. The flaw isn't the bookkeeper, the flaw is the founder delegating strategy to a historian. Part 6. Architecture as an Asset. Unlocking Strategic Advantage. So how does this all build together? The ultimate goal here isn't to memorize the tax code. It's to treat it as an engineering toolkit. Step 1 is making that mental shift. Step 2 is using that toolkit to build a transparent, highly scalable financial architecture. Step 3 is where the magic really happens. When designed correctly, tax compliance transforms from a draining cost center into a massive competitive advantage. And step 4 is the payoff. Whether you operate a local retail network in Dushanbe or a massive cross-border manufacturing venture across Central Asia, building this resilient structure unlocks access to institutional banking, enterprise B2B chains, and, crucially, it attracts foreign direct investment. I want to leave you with a provocative thought for your own corporate strategy today. Take a hard look at your current operations right now. Is your tax structure just a reactive cost center? Or have you engineered it to be a proactive, competitive advantage? It's really time to rethink everything you know about tax compliance, throw away that static checklist, and start building like a financial architect. Thanks so much for joining me for this explainer, and I highly encourage you to go look at your unit economics with fresh eyes today.